Hola, hola, welcome, welcome. You're in the right place at the right time. This is our third workshop out of 6. We're going to talk about entries, and thanks for spending time here. Thank you very much. So, you should have watched workshops 1 and 2, ideally, about market rhythm. Yes. You should have watched those ones prior. Now, we've been talking about the trades that I've been taking in the class if in the Worm and Lighthouse. So if you haven't seen those, you can see the we did have a loser. So the most recent trade on silver was in fact a loser, as you can see here. Now this is a pretty big account, so I've got it's about a $200,000 account, so I've got really small positions on. I'm risking about a quarter, 0.4%. So there's not a lot of risk there because we're just testing it. But what's interesting though is we've only had one loser. So if you'd like to join us, we actually have another live session tomorrow. You can go to the page there where it's showing you the here, let me give you the links here. Link is right here if you'd like to join us in the next session. Okay. And if you have any questions, please type them in the Q&A. That's going to be the best place for it, okay? Cool. All right. So today we're going to talk about entries. And there's a link. You guys should be able to see all the information about the Worm in the Lighthouse course, okay? All right. So when we're talking about entries, there's sort of a misconception. Number one, the first misconception is that your entry determines the validity and profitability of your trading system. That is, although it does contribute, it is not nearly as important as most traders will assign to it. So they assign a very high impact to the entry rules, when in fact, entry rules are just a small part of the equation. The other part is the exit and the risk management rules. We'll show you later in another session. We'll show you how you can use risk to turn a coin flip system into something absolutely brilliant. So something that's like will blow your pants off. So it's really important that you understand. Oh, the question from John: we'll have sessions 4, 5, and 6 at the same time this week. Just confirming. No, I'm gonna change it up, John. Sorry. The way the webinar software is it automatically does it at the same time. So after this session, I'll go in and change it for the next session and the next one. Okay, so 4 and 5 I'll set. I can set 6 as well. It's not gonna be at the same time. What I'm trying to do is give people a chance in Europe to attend and people in in the Americas as well. You know, so that's why I switch it up. Yeah, sorry about that. I should be more clear. But we will have more sessions at this time, yes, but not necessarily the next one. Okay. All right. So, yeah, people look at the entry and they say, oh, this, usually when you, if you're new to trading, what typically happens, we talk about this actually in the next level trading course, where we talk about each stage that you go through as a trader of your development, what you're working on, what the big myth is, and how you can overcome what you're working on. So there's a major challenge at each level of trading. And what's cool about this is if you take a step back and look at the big picture, you can see why each step is the next one. And this is almost universal for traders. It's kind of like humans. We go through similar development as a person. And it's one of the things I studied when I did my PhD in psychology was the development of humans, development of your moral compass, development of as a human, like what do you go through as a person? What are the things that you look back on? If you ask your grandfather, what he thinks about versus your 5-year-old nephew. They've got very different concerns, and it's the same in trading. So we look typically as beginner traders, as newbies, we look to the entry rules as being all important, when in fact they're a part of it, but I would assign more importance to your exit and to your risk rules especially. So that's why we will spend sessions talking about each of those in the future. But for today, we're talking about entries. And so a lot of times what happens is, as traders, we look at the entry and we think, this is what's going to make or break our trade. So if we're looking at an entry on the Aussie yen here, which I would be looking for like maybe a possible sell up here, then we'd wait until there's a kangaroo tail or a big shadow or a double top, something like that up here, where we get a really good sign that, it's not going to go any further. It's going to fall from here. And so keep in mind that your entry rules, actually this is a good one to put our data in here, or our points. Entry rules, exit rules, and risk rules. Those are, I always do that. I always stick it in the wrong thing. That's all right. That's ridiculous. Okay. Entry rules, exit rules, and risk rules are all in the same boat. They all will dictate your the profitability of your system, right? And we'll talk about how you can calculate this and all that, but later. But for right now, it's important to note that all of these things are going to lead to your the profitability of a strategy. Obviously, you are involved in this as well as an executor of the strategy, and we'll talk about that when we dive into psychology. But for right now, we want to focus on this aspect of it. Again, it is not nearly as important as newbie traders will assign it. If you think back to when you first started trading, you probably thought it was everything, when in fact, it's just a piece. So what else about entry rules? Well, entry rules will go a long way to determining your win rate. Now, your exit has a big say in that as well, but your entry rules do also. And one of the things that you should keep in mind is when you're using specific entry rules or testing specific entry rules, it's tempting to say, oh, well, that didn't give me a high enough win rate. When in fact, part of the reason why that win rate was at that level was how you got out of the trade. In fact, I would argue it's more important. So let's think about, so what I like to do in cases like this where there's a debate or it's up in the air, what I like to do is I just go to the extremes. So I go, okay, fine. Let's imagine that we're looking at the 1 hour Euro chart, all right? Sorry, 1 minute, 1 minute I meant to say. All right, so we're on the 1 minute Euro chart here, and here we are, and we say, all right, if my entry is I buy if I get above here. I buy if the market gets above here, and I sell if the market gets below here. Okay, so I'm basically straddling the market, and we used to do this with the news reports right before the news came out, like the non-farm payroll or whatever. We would straddle it with entries, and the market would just rip one side, and you'd cancel the other one as quickly as you could. And then what started happening is you'd get these whipsaws before the news, so it basically became impossible to trade that way. Then you can get your spread widening and all that, so both of them get clicked in and all that sort of stuff. Anyway, the point is, if I had decided that I was going to go long here, let's say that we I gotta let my dog out. Sorry, 1 second. She loses office privileges when she starts getting yappy like that. All right, so when we're looking at this, we go, okay, if we get above this high here, we're going to go long. If we get below this little consolidation spot we're going to go short, right? Now, one of the things that is important to note is that if let's say, for example, and I'll use the other side as my stop. So if I buy here, my stop loss is down here. If I sell here, my stop loss is up there, okay? If we take it to an extreme and say, instead of having it above this range right here, what if I widen it further and go, I'm going to put my buy stop all the way up here and my sell stop all the way down here. So I want to clearly get out of this range, right? Instead of having a tight straddle on the range like we had it, it's a much wider one, right? What would that do to my win rate? Do you think that would improve it? Reduce my average, my win rate? What would that do to my win rate? So instead of using this one right here, instead of using the really tight straddle, I use a much looser one where I say, look, it's got to get up here and then I'll buy, or it's got to get down here and I'll sell. What are your thoughts? Michael, we're going to talk about your question because it's a really good one. We're going to talk about that in just a second. So if I have a really wide straddle instead of the tight one, perhaps it's less likely to trigger it unless it really goes. So if it rockets, let's say it goes up today 100 pips. If it goes up 100 pips, I'm definitely still going to get clicked in, right? Or if it goes down 100 pips, I'm definitely going to get clicked in. It doesn't really matter, right? Even though I'm just a little bit higher or a little bit lower than I would have been before. But here's where it gets interesting. Let's say that I had this buy stop here and the sell stop here. So whichever way it goes, I get clicked in. But let's say that instead of using my stop loss on the other side of the straddle like we have here, what if instead what I decide to do is I use a stop 3 pips away from my entry price? What is that going to do to my win rate? Of course, I'm going to lose almost every time. Almost every time, unless it absolutely rips and keeps going and never turns around. If I have a 3 pip stop loss, I'm going to absolutely destroy my trading system. So you can see that by going to the extremes here, by saying, okay, what happens if I have a 350 pip stop loss? What is that going to do to my win rate? Well, it depends on my exit, right? But and stop rules are exit rules. But if I have a really wide stop, you're always going to improve your win rate and decrease your reward risk ratio. That's the impact of that exit rule, which is a stop loss rule. So stop loss rule is an exit rule. It's an exit rule for a losing trade, right? But that's not the case if we have a if we modify our entries. But modifying our entries doesn't impact as much. And so one of the things that I want to emphasize here is, although there are different types of entries, although your entries can impact your win rate, they certainly do impact the profitability of your system. They are vastly overrated, and in fact, the way that you get out of trades is much more important, and the way that you manage risk is much more important. One of the reasons why I've spent the last 7-8 years doing so much work into risk is because I realized that that's really where the gold is. The ability to use aggressive and or different risk management rules that no one else is using is extremely important, and it's probably the number one way for you to improve any trading approach is the way that you manage your risk. And there are a lot of weird ways to do that. And it's not just the fixed fractional 1% or 2% or whatever that you usually hear in most corners of the internet or in most books or whatever. There's a lot of more subtle and impressive approaches, and we'll talk more about those when we get into risk. So right now we would have been clicked into our trade and we'd have our stop loss down here. Maybe we'll come back to this 1 minute chart, but at this point our straddle would have been triggered here, right? All right, put this one away for now. Okay, so Michael has a question here, and his question is, it seems to me that if your trade goes the wrong way into the red, it doesn't matter how good you are at exits or risk-reward strategies. Yeah, so when I say risk, I'm talking about your risk algorithm that you use. So that includes, when do you move to break even? Do you move to break even? Do you move to zero? So here, going back to our example here. So if price gets up to here into this range, do I move my stop loss to break even? Right? If I get this much profit, do I move to my stop loss to break even? Or if it goes a certain amount, do I move my stop loss here to 0.5 R? So instead of risking 1 R, I'm risking 0.5 R now. 50% of my risk is on the table instead. So these are the sorts of things we're talking about. Profit Bricks falls into that category. We have another course on risk management for Forex traders, which is about fixed fractional, which is another method, the Ryan Jones method. There's a lot of different methods out there that people don't talk about. I don't know why, because I know for a fact that the funds use them. The funds use these approaches, but yet most retail traders just kind of they get as far as 1%, 2%, and that's it. They're done. So it's bizarre to me, but whatever. Anyway, so your entry rules are going to impact your win rate and your reward to risk ratio, just as your exits will. And I would argue that your exits have more. So let's talk about this. Actually, let's bring up a daily. You know what? Let's go to Forex Tester. Let's do that. So I just pulled up the euro today. I don't really care which one we're talking about here, but let's say that I want to go long here. All right, I want to go long because the market's making new highs, and actually, I have no idea what's going to happen. Right, I have no idea what's going to happen. But let's say I want to go long here, and I think that, let me back it up. Do we have any? No, we don't. We just started. I just started Forex Tester. As you can see, I just opened up this project. So I could, if I wanted to be very cautious, I could put a buy stop above the wick of this candle here. All right. So I put a buy stop up there. I'm risking 1%, and I put my stop loss down here on the other side of the candle. Okay. All right. So that would be one option. I could also get in on a retracement, right? So I say this is a big bullish candle. The trend is going to continue. I think this is going up. So I could get in on a retracement. So I could get in right now, buy, and I'll risk 1%. And again, I'll put my stop loss down here, but I'm buying right now, okay? I'm buying right now on the retracement move. So it's retracing this big candle, which is acceptable to me, and I'm not going to wait for it to take out the new high. So which one of these is a better approach? Can anyone tell me which one of these is a better approach? Is it better to get in on the retracement of my big signal candle here, or is it better for me to actually get in when the market clears that high? Which one's better? Buy stop. When the market clears. Here's the thing. It actually depends on what my goal is. So if my goal is to have the highest win rate, then I may want to use the buy stop up here, okay? But that's going to reduce my reward to risk ratio. If, however, my goal is to have the highest reward to risk ratio, and I don't have any regard for win rate, then I would definitely go in on the retracement. So let's see which one's going to work out here. Okay, so they're both in. Okay, so you can see the one that had the retracement is up 113 pips, right? And our position size is twice as big. Now, remember, the risk is the same. So the risk is absolutely the same. We are risking the same amount, 1% of the account, but because we were twice as close to our stop loss, we got in at twice the position size, right? So what that means is if both of these get out at the same price, the retracement one makes more profit relative to the stop loss. Yes? Everyone following? So let's say that we're going to modify these, and we'll just go ahead and modify this one, and we'll put our take profit here. Okay, that's at, we'll do the same. 30 1.31245. 1.31245. Wow. Remember those days when the euro was up there? I guess the governments weren't collapsing back then like they are today. I don't know if you guys heard. It sounds like Canada's going down now. Okay, modify along with France, Germany and France. Okay, so there we go. Not good for the euro. So I have my targets here. I don't know if we're going to, I think we're going to hit it. Okay, we hit it. Okay, so we hit it. So let's just dig into the my window here of account history. That's what we want to see. Yep, there we go. So again, here's the difference. Here's the difference, right? So this is your buy stop. This is going to give you a higher win rate. So you're not going to lose as much. Again, don't take my word for it. Test this yourself. But that one made $67, right? The second one, which had the retracement, made $226. Okay? Again, same risk. Same risk. Same exact risk. It was both. They were both risking 1% of the account, which is, what is that, $100? So risking $100 to make 2.2 R, or we were risking $100 to make 0.67 R. That's the difference. That's what your entries will do for you. And I'm not here to tell you which one is the best one. I'm just here to tell you that this is what you have to consider. So in this case, obviously we were happy with the retracement, but there is an alternative world where that retracement turns into just a fall and it goes straight to our stop. Meanwhile, our buy stop is never triggered, and that's the difference in win rate. Does that make sense? So that really is important to note, guys. That yeah, do you see? Do you see? We had the same exit, the same risk amount, the same fixed fractional risk on both trades. The only difference was one trade was in on a retracement, following the trend. The other one was in on a break. In other words, it's sort of a momentum break confirmation that we still want to go higher. Now, it could have stopped us both out, right? It could have clicked in right here on this wick and then collapsed and gone down to here and stopped us both out. That's definitely possible. However, in this case, the trend continued, and it sort of magnifies the difference between the two approaches. Let's see if we can find another potential trade. Okay, let's do this. Let's do this. Let's do a sell stop. Now, we're gonna call this. This is the end of the trend based on this kangaroo tail. I actually think we're gonna get stopped out. All right, but that's okay. Well, I'm still gonna do this trade. All right. So we'll put our sell stop here. I think this again. I don't think this is gonna work. I think it's gonna be a loser. But let's just see. So I got there, and this is risking 1%. So this is the conservative. And my stop loss again, how many pips are we risking? We're risking 162 pips, okay? Boom. Now, I'm going to do the exact same thing, but I'm going to put a sell limit here, all right? So if it inches a little bit higher than the little candle here, I'm in. And my stop loss is, again, the same spot here, 95 pips. 95 pips versus 162 pips risk, okay? And we'll place that one, 1% risk right there. All right, let's see what happens. Okay, we got clicked in. And again, like I said, I think we're going to get stopped out here, but yeah, we are. Okay, the reason why I said I thought we were going to get stopped out, by the way, it's not some sort of voodoo or anything like that. It's just because these candles were way too bullish on the way up to this kangaroo tail, so I didn't trust this kangaroo tail. And I thought it was going to get blown up, and it did get blown up. However, see what happened here. What happened to our sell stop? Our sell stop, our conservative entry, our sell stop is still sitting here waiting, and at this stage we can go, okay, delete, right? No trade, and let's actually go back to our account history window. And so let's remember, let's call these separate accounts, all right? So my conservative account is up $67.30. My more aggressive account was up 226 minus 104, so that's 126, 122, right? So my aggressive retracement entry is up almost twice as much as my conservative, all right? But if you want to see the difference overall, you should run what I call a horse test. A horse test is when you test two different approaches of a system, and over time you want to see what do they look like overall, and then you go, okay, well maybe I'll go with option A instead of option B or whatever. Does that make sense? Do you see how this is, it's what we've done with these two trades? Luckily, I didn't know what was going to happen, but luckily we've had a loss and a win, so it sort of highlights where the sell stop or buy stop works better and where the sell limit or buy limit works better. Yeah? Okay. Let's talk. Okay, we got some comments here, which is awesome. Thanks, guys. It makes it everything good, because if you say something, I know a lot of other people are thinking the same thing. James says, if you enter on retracement, what signal do you use to decide what level to enter? Seems like you're trying to pick the bottom of the retracement. Okay, in this case, James, what I was doing is I was just looking at this. I don't think I can zoom in anymore. But do you see this wick right here? So this is like what I call the leg of the kangaroo tail. Imagine we're a drone, right? A lot of drone talk lately. So you're a drone hovering above a kangaroo, and this is their haunches, their leg right here, and then this is their tail right here, and you're looking down on the kangaroo's head, which would be right here. And so what I'm saying is, a lot of times, not always, but a lot of times when you get a kangaroo tail, it's somewhat symmetrical, where this leg right here goes about the same amount. The second leg over here on the right goes about the same amount deep into the kangaroo tail. And so that's, I have my sell limit a little bit above that wick, thinking that if it was going to reverse, it would go in about that much. Yeah? Again, what I thought was going to happen is exactly what happened, which I thought it was going to blow up the kangaroo tail, because I thought there was way too much bullish momentum here. And again, when you're in a trend, you're going to see reversal signals like this. They get blown up all day long, for days and days and days. We're on daily too. Yeah, we're on daily here. So this is a very strong trend, and we've been stopped out on our limit because we didn't wait for the market to tell us that it wanted to go lower. So yeah, so just to answer your question, in the case of a kangaroo tail, I look for symmetry on the other side of it, basically. You're not always going to get it. Sometimes you miss out. Sometimes it goes without going high enough to click me in. Yeah, and John says, ultimately the expected value may wind up being similar between the two methods. It may not, but also, and this becomes really important, when you start using aggressive risk tactics like profit bricks, win rate becomes super important, and so that may help you decide, right? You may want to decide which approach you're going to use because you have an eye towards using a certain risk algorithm, such as profit bricks. Yes? Okay. So yeah, very good point, John. Adil, I have a question. When identifying a trade entry using candlestick patterns, which patterns provide the most reliable signals for entry, and how should they be combined with other indicators like moving averages or orders to confirm the entry? Okay. Okay. So you're not going to like my answer. But I'm going to look at we'll look at several examples because you bring up a good point, and it gives us some food for thought here. But Adil, okay. So, and this is really important. I was just talking to one of our one-on-one coaching members about this approach to trading. So the way that I look at trading is we all trade our beliefs. If I give you a strategy, or if you find one in the dark corners of the interwebs, and you find this brilliant strategy and they have the best track record you've ever seen, so that's why you're going to trade it, right? You will trade that for some time, and then you'll have a drawdown, and then you will quit, and you will either modify that strategy or find a completely new strategy and start all over again, and you will trade it for some time, and then you will give up, and then you will modify that or find a new, and so forth. That's the cycle of doom that I wrote about in the Naked Forex book, right? So what's interesting is, in the end, we're not going to trade someone else's beliefs. We're not going to trade someone else's strategy if it doesn't fit our beliefs. So I think you're better off building out a strategy based on your beliefs. So if you want to build a strategy based on your beliefs, you have to understand what you believe. So do you believe it's best to get in on a retracement? Okay. Then if that's what you believe, you've got it. You've got one building block of your strategy right there. Do you believe that it's best to use indicators along with price action patterns? Yes? Okay. If you do, then let's do that. Let's just put in an indicator on here. Charts. We're going to use the old MACD. Where is my MACD? No, I don't have MACD. MACD is under oscillators. Surely it's under mouse. Yeah, okay. MACD new. Okay. Oh, that's wrong. Is it 1226.9? Does anyone know the standard settings? Let me just bring up my my trading view chart here. I think it's because I had a MACD on my trading view. 1226. Yeah, I think it's 1226.9. Yeah, 1226.9. Okay, so 12 is fast. 26. 9. Yep, there we go. Okay. All right. So, oh, right. Okay. And then we will, okay. So what we're going to do here, so if my belief is that I should be using an indicator along with price action patterns, then I might wait for that. So for example, divergence is a big one. A lot of traders love their divergence. So we're in a very bullish trend here, but I'm going to wait for divergence on the MACD and some sort of price action pattern, okay? So do we get a higher peak here on price but lower on the MACD? That's the question. Yes, we have a higher peak here on price, and let's see if we roll over and make a lower one on this. No, we're not going to. Okay, so there we go. We've got it. All right. So, I don't really see. Okay, so does everyone see what? Okay, let me draw the line here. So this is what I'm looking at. I've got a higher high on price, but yet I've got a lower high on my MACD down here. Okay, you see that right there? So I've got a lower high there, but yet I've got a higher high, doink doink, right here. So I don't really have a good price action pattern. I wanted to sell there. Okay, well, using this, you would just be using only the MACD. So I didn't really have a nice pattern here. This could be a pullback and then it could fall. Yeah, there you go. So that was like a bearish flag pattern right there. Now we're consolidating. Pull back up. Maybe we'll hit this and nope. I don't think that's going any lower. Okay, so in this case, Adil, what we're talking about here is I was just looking at the MACD and I didn't get I didn't get a big shadow or anything like that here. If I had gone to weekly, which I almost did, I was going to go to weekly and see if we had the chance to if it was like a moolah top on the weekly. That's what I was looking for. Hold on here. Where's my Oh, well, that's all right. Okay. So the answer is if it fits your beliefs, you may want to add the RSI or momentum or MACD or moving averages or whatever. So for example, a lot of traders, they'll use moving averages as dynamic support resistance, and they'll trade kangaroo tails and big shadows off of those. I use systems like that. So you could do that. You might look for divergence and some sort of like if there was a big shadow up here at the second top, a big shadow, and then I had divergence here, and then so that was time to sell, right? So there's lots of different ways that you can approach it, but the most important, the best thing I can tell you is try and make sure that that your beliefs jive with what you're building. So don't it's cool to take elements from other people's trading strategies. I think you should do that, and you get a lot of good ideas from watching my videos on YouTube or other people's or whatever, reading books and stuff. I mean, no one reads books anymore in trading. That's how I learned it. I got all these books from Interlibrary Loan, and but today I know you can just go on YouTube or whatever, which is fine, right? which is great. It's great. However, it's important that you don't do something because you don't use this entry because it's the most profitable or because so-and-so guru said it was or that you should. You should use it because it makes sense to you, right? I think you should be using a simulator like Trading Markets, or sorry, Forex Tester here, or Naked Markets, which is another one. You can go to Naked Markets. You can tell Dennis that that we sent you. If you're in our forum, you can get a discount as well. But nakedmarkets.com is another one that's really good, and you can use that as well if you'd like to, do your testing and get your hands dirty and get your data. That's how you're going to get good at this stuff. It's all about practice. You can certainly practice with live accounts. It's just much more expensive than plonking down $200 for a trading simulator, right? Or whatever it is, $150, whatever it is. I don't know. There's always deals going on. If you want Forex Tester, you can go to Naked Markets. You can tell them that I sent you, or you can go to fxjake.com/tester and get Forex Tester, which is the one I have here, for a discount as well. This is where you earn your profits is in backtesting. Okay, so your entry rules, exit rules, and risk rules determine the profitability of your strategy. You can impact your win rate by modifying your entry rules. One of the big and your reward risk ratio. One of the big points of emphasis is for you is going to be: do I get in on a break of a candle, so a buy stop or sell stop? So the market's going that way, and I want to get in. Market's telling me it's ready to go that way, so I'm saying, okay, I'll jump in now. Or do you choose to get in on a retracement? As we've seen, there's good things and there's bad things about both. You get to choose. When you get a moment, are you accepting students for individual coaching? Where can I find info? We do. We just took one yesterday, so we do have a slot, but I have to say it's not for everyone, right? And the best thing you can do if you're interested in coaching is to go here, which is nakedforexnow.com, right? So I'll post it in the nakedforexnow.com, and then click through here to coaching. Just go through here and click on the right things for you, and then go to coaching, and you'll learn about it. Okay, there's the link to Naked Forex Now. And if we don't have any slots, then we have to talk to you basically, yeah. So yeah, just go through here. All right. Thank you, says Adil. No problem. Thank you, says Anonymous. No problem. Yeah. Okay. What else? Oh, the last thing I want to talk about here, unless we have any questions, this is a writer downer. Okay, this is a writer downer. You may get to a point, and this is what we talk about in our in the private forum at Naked Forex Now, and we do a lot of work with our private coaching clients. This is a really good tool. I want you guys to use it. This is one way for you to determine whether or not your trading system entry rules have an edge or not. Okay. Now, we actually have a whole course about the statistics behind this. It's called the Henry Ford. This is the one I was telling you about different developmental levels as a trader. But the Henry Ford course here is all about determining whether or not your trading system is broken. So once you've built your strategy, once you've tested it, and once you've decided to go live, and then it doesn't go well, and you're trying to figure out, am I on a normal drawdown or is it broken? That's what Henry Ford is about. However, if you are interested in figuring out whether or not your entry signal is broken, does my entry signal work? Is it worth anything? Or is it useless? You're trying to figure out, because a lot of what trading is we're trying to figure out, is it my system, is it my risk, or is it me? So me, psychology, execution, risk, I have complete control over that. System, entry and exit, right? So if I'm trying to figure out if my entry rules are no good because I'm building my strategy and I'm worried that it's not giving me the results, it could be my exit, but I could do a lot of work on exit and be doing that for no reason because my entry rules are dog poo, right? So if your entry rules are dog poo, or you suspect they are, what you want to do is you run a juice test. Juice test is super simple. All you do is you go into Forex Tester, you wait for your signal. So let's say I'm doing big shot. I'm gonna get rid of this indicator. I can't deal. I don't want to. List of indicators gone. Okay, cool. So what I do is I go, okay, I wait for like a big shadow, right? So this is a big shadow right here. And then I see, so I'll just buy right now, okay? Buy, I don't need a stop loss because what I'm trying to do here is see how far does the market go 3, 5, and 10 candles later. 1, 2, 3. The market is up 154 pips. So I write that down. Or 154.9 pips. And that's after 3 candles. 4, 5. After 5 candles, it's up 142 pips. 6, 7, 8, 9, 10. After 10 candles, it's up 62 pips. Okay? So what I'm doing is every time I get the signal, I'm writing down how far do we go after X number of candles. 3, 5. This is 3, 5, and 10 days. Okay? What you're trying to see is there an edge there? Is there any edge for your entry? Again, we're not looking at stop losses. All we're trying to figure out is once I get a signal after X amount of candles, how far in the expected direction are we going? And that's going to give you a really good sense of, 1, whether or not there's an edge, or 2, what your exit should look like. Because if the 10 candle results are the best for you, for your signal, you want to make sure you have an exit that is able to get you that, right? To get you out at around 10 candles. Does that make sense? Anyone having troubles with this? Or is this making sense? Yes? Yes? Okay, cool. All right, awesome. All right, great. Okay, cool. All right, great. Glad to hear it. Anything else? Anybody else interested in anything we're talking about here? Any questions about entries? We talked about win rate. We talked about buy stops and retracement entries, sell limits, buy stops, sell stops. We talked about getting in on the retracement, the pluses and the minus versus breakouts. We talked about the juice test. The most important thing that I want you to walk away with is that this is under your control. You don't have to use someone else's system out of the box. You can and should modify it. I think that's really important that people understand that, okay? Really important. Yeah, I have a lot of strategies. I have over 30, but I don't use them all the time. What I typically do is I'll look at the markets and I will say, okay, this looks like a trade. I'm going to use this template to get into it. Michael says, is there an intrinsic link between certain entry strategies and the exit strategy? Yeah, the trader. No, okay. I would say no. I mean, I know what you're saying. I mean, in a way, in my mind, and I don't think this is for everyone, like everyone's going to think this way, but in my mind, for example, if you're using a trend following strategy, you should darn well be using a trailing exit approach, not a target. Now, look, you might have one target and then, half of it target and half of it has a trailing exit. But to me, if you really want to take advantage of the fat tails which show up from getting yourself in a trend following position, you kind of want to make sure that you're doing it with a trailing exit, right? Because a trailing exit is the only way that you can say to the market, hey, market, go as far as you want and give me as much profit as you want. It's the only way you can use that approach is with some sort of trailing exit. Now, I will say that Emmanuel, if you go into the private forum, Emmanuel actually has, let's see, it's under Donchian. So he's got this Donchian system, and he was using exits. I was actually, it was interesting, right? Okay. Also, Mark was doing Donchian testing as well. So here's Emmanuel's Donchian trend following system, and he actually used, he actually had targets, which I found fascinating, right? Because to me, you wouldn't, to me you would. I mean, you might have a target, but also use a trailing exit. But again, that's my beliefs, right? My beliefs is that if you're going to trade a trend following system, you want to have some sort of element there that's going to allow you to take all the profits. So it kind of, it kind of depends. So that's probably not the answer you wanted, but yeah. Yeah, it makes sense. Okay, I'll tell you one thing, Michael. What I do, John, just John, can you? I'll send you a link, John. I'll send you a link right after this. Okay. I'll give you a coupon too. Okay, so let's talk about this because this is really important. And we'll get more into this in exits, but here's what I would say. Michael H. The reason why I use split exits, so I almost in all my trades, not always, but nearly all my trades, I will have a target, and I will have, actually you can see that in my screenshot that I shared with you, right? In my trades here, you'll notice that the gold trade, one of the gold trades here made $148, and then the other one here made 95. So the trailing exit was the 95, right? And then the target was the 148. The risk was about 125 on that trade, okay? So the risk was $125 per trade. So one didn't have a 1-to-1, the other one had a little bit better. Same thing over here. You have your pound New Zealand. This pound New Zealand trade made $77, but there was another pound New Zealand over here that made 131. So again, my trailing exit only made 77, but my target made 131. So what's going to occasionally happen is you're going to have a really big winner, like the euro pound is a good example. Look at the euro pound here. Look, euro pound right here. It made $272 on the trailing exit, and the target here made 156. Yes? So the target made less. So what we're hoping for is that you get some really, because it's not going to happen all the time, but you get some really big winners on your trailing exits. But the reason why I use both trailing exits and targets is because psychologically, it's easiest if you can say after every trade, I was right. because half the time, if you use targets, it was about the right call, right? And the other half the time, or maybe less often, but using a trailing exit means you make more, right? So by using a trailing exit and a profit target, I am allowing myself psychologically to sort of ease myself into the realization that, I'm never going to know if it's going to be a runner or not. But if I split it up and I allow it to be a runner, then at least I feel good when it finally does run. Yeah, does that make sense? So it's really more about long-term mental health than anything else, which I know it sounds ridiculous, but for me it works, right? So that's why I do that. Yeah. Okay. Yeah, the split. Yeah, Michael loves the split. The split really helps because, like I said, either way you're right. A lot of times it'll just go to your target. Like if you have a 1 hour target or a 2 hour target, it just barely makes it to your target, and then it reverses, and then your trailing exit makes less. Like we saw in my example trades here, all of these trades that I've been taking on the Worm and Lighthouse, I've been doing the split exit, but they don't always work out. So it's just the luck of the roll, right? I mean, that's the way it goes. Yeah. Okay. Okay, cool. All right, John, I'll send you an email. And thanks, guys, for spending time here. I will update the software, the webinar software, so you will get a new invite to the next session where we're obviously going to talk about exits, right? So that'll be session 4. We'll talk exits, and we will get later into risk and psychology in sessions 5 and 6. But next time, we're going to talk all about exits. I'm going to give you a whole bunch of different types of exits that you may want to test, pluses and minuses, all that sort of stuff, okay? I really appreciate your time. Thanks for spending time here, guys. Have a wonderful week. Thanks, Michael. I'm glad you liked it. I'm glad you guys liked it. Thank you so much. Have a wonderful week, and we'll see you soon. Okay, bye.